Welcome to the program. My name is Marty Schenkman. I'm joined by two brilliant and illustrious colleagues, and that's why I'm going to let them do most of the talking, Jonathan Blattmacher and Mitch Gans. And we're going to talk about Rev Ruling 2023-2 and hopefully give you some insights and a balanced and practical view of what can and should be done in light of that ruling. And if you're not familiar with the ruling, you will be in short order. Couple of quick comments. These video clips are for entertainment purposes only. The PowerPoint is available on the console for download. If you miss it on the console and don't get it down in time, Peak Trust Company and ILS, who are sponsors, will have it on their websites, and I'll post it to my website. There is a growing library on my website of over 150 video clips, many of them with Jonathan. We do not give CLE or CPE, but you will be sent a certificate of attendance from the system. If for any reason you don't get that, we cannot manually override it to do anything. If you have questions, the best thing to do is not to post them in the panel, but rather to email Jonathan or me directly. Our emails are at the end if you don't have them. But don't post to the console. It's better to email us directly. Vanessa, tell us a little about ILS.
I will. Thank you, Marty. First of all, thank you for allowing us to sponsor this webinar, and thanks to everyone for attending. My name is Vanessa Kanega. I'm the CEO of Interactive Legal. We provide, if you're not familiar with us, we provide document drafting software and other educational resources for estate planning and elder law attorneys. You can certainly draft grantor trusts, which you'll be hearing a lot about today, as well as many other documents using our programs. So if you would like more information, if you're interested in a demo, please visit our website or contact the email that you see on your screen here. Thank you.
And just for those that haven't started gearing up for 2026, the exemption, as everybody knows, is being cut in half, and we will all be doing more slats and DAPs and spats and hybrid DAPs than we can shake a stick at. And I know that you can draft all of those in ILS because I have.
You don't want to be copying, pasting, and making mistakes. So in that kind of pressure.
And you want to be more efficient to make more money and have an easier time of it and be able to better tailor documents. All the above. So, Andre, tell us about Peak Trust.
So I want to thank you first for allowing me to be on the show with you, and welcome to everyone, and thank you for attending today's webinar. My name is Andre Sears, and I'm the Business Development Officer for Peak Trust Company. We're pleased and honored to be able to sponsor today's presentation. Peak Trust Company offers a full spectrum of trust services serving individuals, families, and their trusted advisors. We offer flexible and customized administrative services for all types of trusts. I invite you to visit our newly designed website at www.peaktrust.com. And if you should have any questions, feel free to reach out to me or any member of our Peak Trust team. Enjoy the webinar. Back to you, Marty.
So if I set up my slats and DAPs and hybrid DAPs with ILS, and I like to put them in different jurisdictions for each spouse, if I'm correct, I think I can do that with different entities of Peak in Alaska, Nevada, and now Delaware.
That's correct, yeah.
There you go. Okay, without further ado, we're going to dig into Revenue Ruling 2023-2. And 2023-2 is going to say that you can't get a basis step up on assets in very broad terms in a grantor trust that's not included in your estate. But what we're going to do is not just tell you about the revenue ruling. We're going to have Jonathan educate us about some of the background and knowledge that leads up to it. And Jonathan and Mitchell are going to enlighten us all, including me, about a lot of the different nuances and aspects of it. And then near the end, what we're going to do is talk about some of the practical implications. So it's great to understand something. It's even better to understand the historical background to it. But I always like to say, okay, what do I do with that knowledge? And we're going to do that too at the end. So Jonathan, I'm going to just move the slides along as you tell me to, or as I follow along. and Mitchell will interrupt you every time he has a thought or insight.
Great.
So take it away.
Well, Marty, let's go to our first one. Let's have a little background. Everybody on this call may know about it, but I've always felt that one of the truths is that to divide income is to reduce income tax. And that's always been true, even more so in the past, because you get an additional run up in the brackets, which can save money. You get additional exclusions and exemptions. And although the tax law has tried to curb some of that, it's still basically true. If you divide income, you reduce income tax. And in fact, the standard plan by people up until very, very recently was to give income producing assets to as many members of your family as you possibly could. So if you have 3 kids and a spouse, you'll give income producing assets to your spouse so he can report income, and to each of your kids so they can report income. And again, each would get the benefit of bracket ride. And even today, each individual gets the benefit of up to a $10,000 deduction for state and local income taxes. You alone only have 10,000. Even if you're married, you get only 20,000. But if you have a couple of kids, you get another 10,000 each, which again, in the right circumstance, can save a lot of taxes. Now, taxpayers began to really push the envelope on dividing income in the 1930s as the United States income taxes drastically increased as we prepared for entry into the Second World War. And they began to basically transfer property to other entities such as trusts, because trusts under US tax law at that time were completely separate and individual taxpayers and had the same bracket run up as basically each individual had. In fact, I have a colleague who had a client who created 1,000 separate trusts to divide income. And when they were coming up, which I'll mention in more detail in a moment, with the consolidation of all trusts into one, he hired a lobbyist, and they kept the separation if the trusts were created before a certain date in 1984. So he got the benefit of that, although now he must pay an awful lot of money in return preparation fees.
I was going to say, his accountant must love him.
Oh, the accountant does love him. Mitchell, you and Marty know that practitioner quite well, and she's very proud of her client who did it even before she represented him. But in fact, what the IRS started doing was this was costing the federal government money. And as I've often said, the IRS is only in it for the money. And when it sees ways in which taxpayers are reducing their taxes, it goes ahead and it tries to shut it down. And what the IRS tried to argue in these early cases, what in substance, the income still belonged to the donor, the person who originally owned it. So even if you gave, say, income producing stock or a bond over to many family members or trust for family members, the IRS began to argue in substance the original owner was still the owner of that property, and therefore the income that property generated should be taxed to him or her. Let's go to our next slide, Marty. And this kind of came to a head in a very famous case called Halperin versus Clifford. It's known as the Clifford case, and the doctrine that's come out of it is cited there from a 1941 Supreme Court decision. But the IRS only had partial success with that. And so what the Treasury did was it adopted regulations under the 1939 Internal Revenue Code. In fact, at one time, there were over 400 cases pending in the courts of appeal in the United States to determine whether or not the original owner, the grantor of a trust, would continue to be taxed on the income because of the doctrine of substance over form. And they wrote very, very detailed rules, and those grantor trust rules, as they came to be known, because they would basically attribute the income back to the grantor of that trust. And they did that, and they did it by regulation. But in the 1954 Internal Revenue Code, They basically made those as part of the Internal Revenue Code, almost verbatim. There are virtually no changes. And they are in many ways some of the most complicated provisions we have in the tax law. The thrust of those rules was to make the trust grantor, or in one case, the beneficiary, where the beneficiary had the unilateral right to withdraw all of the property from the trust, to make that person the owner of the trust and thereby cause the income to be attributed to the grantor. And where that happened, it foreclosed the division of income being effective for income tax purposes, because you were treated as still owning the trust, and therefore the income would still be attributed to you. And as a consequence, trusts were regarded as bad if they were these so-called grantor trusts. And in fact, I can remember my father, who was a tax lawyer, talking about defective trusts. Now, people today think of a defective trust as good, but the reason they were called defective, it was bad to have the income of the trust attributed back to the grantor. That was bad, that was wrong. So the trust, therefore, was defective in being able to provide the division or splitting of income. And in fact, even today, people call them intentionally defective grantor trusts. Well, that's a big mouthful. You don't have to say it, because a defective trust is a grantor trust. So when you say a defective grantor trust, you're repeating the word 2 times from an historic perspective. And when you say intentional, well, it doesn't matter whether the grantor trust was a grantor trust because it was intentional, or merely because you violated one of the many, many rules under the grantor trust provisions of the Internal Revenue Code. They are some of the most complicated ones. In any event, the Tax Reform Act of 1986 basically changed that, because one of the things it did is it compressed the tax rates for virtually everyone. Trusts no longer got a big bracket ride anymore. They were limited, so that today, even after adjustments for inflation, the trust reaches a top income tax bracket today of about $14,000 at about $14,000 of income. So again, this lawyer I know whose client created 1,000 trusts, he only gets a run up in the bracket on $14,000 per trust. And I don't know what he views as that saves him, but again, it's not all that money. It's not like the old days where trusts got the same write-up as everybody else. And for a long time, it was the same as a married person filing separately. But the 86 Act said, no, we're going to have trusts that are not grantor trusts, where they are separate and independent individual separate taxpayers are going to have to reach the top income tax bracket at only $14,000 of income. This was really shocking. And there was kind of a crafty lawyer, Marty, maybe you can guess his name, or Mitchell, maybe you, who decided, grantor trusts would actually be good for estate planning. They may not be available anymore for purposes of dividing income and thereby reducing income taxes, but maybe they would be good for estate planning, because the lawyer claimed that the grantor would have to pay the income tax on the trust income, allowing the trust to experience income tax-free compounding, perhaps the most powerful force in all of financial planning. If you run numbers and you compare, for example, $1 million and you earn 6%, because you don't have to pay tax on it because it's attributed to some income attributed to someone else, as opposed to 6% after tax, which might leave you, let's say, 4 or 3.5%. The difference is enormous. It is extraordinary. Now, the IRS got very mad at that lawyer for going around the country telling everybody that you want to create grantor trusts on purpose. And it issued a private letter ruling, which of course is not official precedent, 9444033. And in there they said that if the grantor picked up the income and paid the tax on it, she'd be making a gift unless she got income. And in fact, in almost every ruling I asked from the IRS, they made me put a provision in the trust that the trust would reimburse the grantor for the income taxes the grantor had to pay, because the income of the grantor trust was attributed to him or her. And that was it. And I told the IRS, I wrote a letter to the head guy there, and I said, if a taxpayer took a position as ridiculous as you've taken, which is that by paying your income tax liability, you have made a gift, you'd either have her arrested for tax fraud or you'd have her put into an insane asylum. Well, he and I had a very harsh discussion, and finally, 10 years later, in Revenue Ruling 2004-64, the IRS conceded that the grantor's payment of income tax on income imputed to her under the grantor trust rules was not a gift. And by the way, that caused a lot of problems because then they were facing all sorts of trusts where you had this requirement of the trust reimbursing the grantor. So if I'd gone in for a ruling and the service gave me a ruling because they forced me to put in this provision that the grantor had to be reimbursed for the taxes, that would cause estate tax inclusion. In fact, in 2004-64, they said if it was mandatory, it would cause estate tax inclusion. Well, how do they take care of that where they had previously told taxpayers, we won't give you favorable rulings unless you have that provision? They came up with a new effective date. If you were before, about 2 months before the 2004 ruling came out, they said, we're not going to take the position that you have a state tax inclusion because you have a required reimbursement to the grantor for the income taxes she's paid on the income imputed to her under the grantor trust rules. Now, there's another benefit that this crafty lawyer thought about, which is that if it's a grantor trust, and yet it's going to be out of the estate, and this brings us even a little closer to what we're going to be talking about in detail under this 2023 ruling, it was that you could then sell an asset to a grantor trust without any gain recognition. And in fact, if the trust gave the grantor back a note which bore at least the applicable federal rate of interest, the AFR, which would prevent it from being a gift, it meant that there would be no income tax on the interest or on the gain at all because it was a grantor trust. So the IRS, again, was not very terribly happy about that. Let's go to our next slide, if we could, Marty. Now, there were 2 articles that came out by very well-respected practitioners in the United States saying that this notion about having the grantor buy asset or sell assets to a grantor trust in exchange for a note, an installment sale for a grantor trust, whereas Marty, what do you call those? You call them note sales,
Note
right?
sales.
Yeah, note sales, which I think is a good way to put it. But these articles came out and said that there would be gain recognition when the grantor died. Why? Because in Revenue Ruling 77-402, the IRS had taken the position, which was reflected in regulations at a later time, I think 1980, right, Mitchell?
Yes.
Right, 1980. The IRS said that if you had a grantor trust that had a asset that had debt on it, and grantor trust status turned off. In fact, in the Revenue Ruling 77-402, it was an intentional turn off from the grantor, but I don't think the result would have been different. The grantor would be deemed to have transferred the asset at that moment for the first time, because the service's position was, while the assets are in the grantor trust, the grantor owns those assets for all income tax purposes. If grantor trust status ends, all of a sudden the grantor doesn't own the asset anymore, and therefore there had to have been a transfer. And if you had a negative basis asset where you had liability in excess of historic basis in that asset, you would have gain recognition, essentially under the Crane case and its brethren that has happened since then. So that was in there, and people began to say, you see, that this strategy that Jonathan has come up with is flawed. And Mitchell and I decided that we would write an article, and we wrote one that was in the September 2002 issue of the Journal of Taxation. And in that article, is by Mitchell and me and by a colleague of ours, Hugh Jacobson, we gave 7 reasons why there could be no gain at death when the grantor died and there was an installment sale to a grantor trust outstanding. And we're not going to go into the detail of that, but one of the guys who wrote one of the articles, actually it was two lawyers together, called me after the article was published and said, Jonathan, you and Mitchell are right and we are wrong and we apologize. And in fact, again, he did this at the beginning of 2002. And I called him a couple of months ago and I said, I'm not going to quote you, but I want to make sure that my memory is correct, that you actually called me. He said, not only did I call you, I remember when I called you and we were wrong and you and Mitchell were correct. There is no gain on death where the grantor of a grantor trust dies and grantor trust status ends as it has to when the grantor dies. And then the other lawyer who wrote it wouldn't concede it. But finally, when a 2009 CCA came out, which seemed to be on point that there was no gain at death, I called his office and I said, can you get a message to this lawyer? And the partner of his that I spoke to said, Jonathan, does this have to do with CCA 2009 28037 or 37028? And I said, yes. He said, Jonathan, I have a letter from him to you. It says, Dear Jonathan, I concede. So, and we'll get into this a little bit more, but the concept of there being gain at death when you have even a negative basis asset isn't there. And again, there is not a negative basis asset when you've made an installment sale to the grantor trust. In fact, there's been no sale at all. Why? Because the services said so. It says I still own the assets in the grantor trust. That's critically important to understand. That is the official position of the Internal Revenue Service. And Mitchell's going to go into detail about what they said in Revenue Ruling 2023-2 about that. But that has been the position at least since 1980, if not going back to Revenue Ruling 77-402. But remember, when you make a transaction with a grantor trust, nothing has happened in the income tax world. You still own the assets. Now, on this issue about what is that, we also turned to the article, and this was primarily Mitchell's thought, was a brilliant thought. Let's talk about what is the basis of those assets in the grantor trust once the grantor trust status ends by reason of the grantor's death. So we wrote that up as well. And we said, when Mitchell will go through this, there are three possibilities, but we think a very strong case can be made that there is an income tax-free step up in basis, even though the assets in the grantor trust are not includable in the grantor's estate. Well, the IRS has taken somewhat inconsistent positions in that CCA 2009-37028, where they said flatly, no, you do not get a change in basis when the grantor dies and grantor trust status turns off, as it must, because there's no longer an individual to whom the income credits and deductions can be attributed. And it said no. It didn't give any reasoning. It just said, no, you can't get that step up because there's no estate tax inclusion. And then in a private letter ruling, and by the way, neither a CCA nor a private letter ruling can be cited or used in precedent, in 2012, 45006, even though it dealt with a foreigner, they said, yes, if you have the asset in a grantor trust, when the grantor dies and therefore grantor trust status is turned off for US tax purposes, there is an automatic change in basis in under section 1014, which we'll get to as well. Now, a lot of people thought Mitchell and I even suggesting you might be able to get a step up in basis. We were absolutely out of our minds. But surprisingly, perhaps, Bernie Sanders, some of you may have heard of Bernie, the independent senator from Vermont, actually turned in a bill. And in there, he said, you cannot get a stepped up basis under section 1014 when the grantor dies and assets in a grantor trust if they're not includable in the grantor's estate.
Jonathan?
Yeah.
If Bernie felt he had to propose explicit legislation to say that this cannot happen and you cannot have a basis step up, doesn't that suggest that there had to be at least some merit to the idea that there may be a step up? Why else would he propose it otherwise?
Marty, I can't imagine. Why would you do something if the law was clear? I mean, you just go after taxpayers. But yes, Bernie said that. And in fact, Representative Pasquale, who's a member of the House Ways and Means Committee, he's from New Jersey, actually wrote a letter to Janet Yellen, the head of the Treasury, saying, you have got to do something about people taking the position that when the grantor of a grantor trust dies, there's a stepped up basis under Section 1014, even though the assets are not includable in his estate. In fact, that really was the genesis for the issuance of Revenue Ruling 2023-2. Well, Mitchell and I explored in some detail which one of the provisions in the code which determine basis should apply. Is it 1012, which deals with where you purchase an asset, and generally it says that the purchase price is the basis of the asset in the hands of the purchaser. 1014, which is an asset which is passed from a decedent upon death, or 1015, basically a gifted piece of property, where the basis of the donor, subject to possible adjustment, would carry over. So we explored those and we came up with a conclusion. It wasn't entirely clear, but we felt there was a very, very strong argument that 1014 could apply. Now here we've laid out Section 1014, and I'm not going to go through it all, but I'm just going to cover a couple of parts of this. 1014A basically just say the basis of property in the hands of the person who acquires it from a decedent is its fair market value of death. Now we have a lot of exceptions. We have no step up for income in respect of a decedent. We have a special rule if you elect alternate valuation, but basically it says if you acquire something from a person by reason of that person's death, basis will equal its fair market value. And that's it. Now 1014B says the following property is going to be considered to have been acquired from the decedent. Now notice it doesn't say only this is the way it is. It says the following property shall be considered as being acquired from a decedent. And it puts in a lot of things, but there are a couple of things that I will point out. One is if you take a look at subdivision 9 of that section 1014B, it says it will be treated as acquired from the decedent by reason of death if the property is required to be included in the decedent's gross estate. And again, it's got exceptions. The property shall not apply to annuities. It doesn't apply to property which paragraph 5, which goes before, is there, or property which is described in any other section of the paragraph. But notice it doesn't say in the other paragraphs up to 9 if it's required to be included in the gross estate. Now, a lot of those things that they describe under B, 1 through used to be 8, but some of those have been taken out. Some of those would be in the estate, but something like 1014B6, which says that the surviving spouse's half of community property gets an automatic change in basis when the first spouse who has the other half of the community property dies. That's a great thing to have is community property, because when the first spouse dies, not just does that deceased spouse's half get a stepped up basis, but because of 1014B6, the survivor's half gets a stepped up basis, even though it won't be includable in the estate of the first spouse to die. So this, when you look at the words here, are kind of strange. And in fact, Mitchell, why don't you tell everybody about the conversation you had when we turned in this article to the Journal of Taxation and the editor, John Huffaker, called you about it?
Yes, thanks, Jonathan. What a great setup. Thank you so much. Fantastic, comprehensive, and wonderful. Yes, so that's a great moment for us that we obviously both recall from 20 years ago. We wrote the article in 2002, and I think we started off thinking about what are the issues. And I think one of the issues, obviously, we wanted to focus on, as you said, Jonathan, is whether there's gain at death. If you put the assets into an irrevocable grantor trust, and there's liability encumbering those assets, is there somehow gain at death? And so that's where we started. And then we got into the question, and I think we concluded, we concluded there should not be gain at death. And then we got into the question of, as you suggested, what's the basis for the assets in the trust after the grantor dies? And what we did was we did a kind of a process of elimination. As you say, Jonathan, we looked at the 3 possible sections, maybe 4 possible sections if you want to think of 1015 as having 2 components, right? We looked at section 1012, as you said, cost for property acquired by purchase. 1014, of course, we looked at that in terms of property acquired at death from a decedent, by bequest or whatever, as you've just discussed. And then we looked at 1015, which is the section that covers gifts and essentially gives you a basis equal to the grantors or the donors basis. And we went through it and we said we thought that there was a compelling argument, as you said, Jonathan, to be made that 1014 should apply. Now, when we did that, Jonathan and I, in discussing it between ourselves, we thought this is a very provocative assertion, right? Because a lot of people have this impression that the only ticket, the only route by which you can get a basis adjustment under 1014 is if it's includable in the gross estate. And of course, if we're dealing with a trust which was used as the receptacle for an installment sale, obviously the trust was drafted in a way to keep it out of the gross estate. So here we are dealing with a grantor trust that's out of the gross estate. And the question is, can 1014 apply to the assets in that trust? Now, we said yes. We think there's, as Jonathan said, I think that was the phrase we used, we thought there was a compelling argument. We didn't say it was necessarily right, but we said it was a compelling argument that 1014 could apply, fully appreciating the provocative and counterintuitive nature of that claim. But we made the argument. And what we said was that it all flows from the IRS's revenue ruling, example 5, and the IRS's ruling in Rev Rule 85-13. So we write the article. I'm just gonna,
Marty, go to the next slide, please.
I wanted to answer what you set me up for, Jonathan. So we write the article, we submit it to the Journal of Taxation, and frankly, I think for the first time in my career, I got pushback substantively on an article. I mean, typically you write an article and people, they're happy to, edit it and whatever, but usually they don't pick a fight or push back on a substantive issue. I think this is one of the only times, I don't know, you're Jonathan, if you're in your experience, I think you and I agree, it's probably a first for both of us, where the editors came back and pushed back on a substantive point that we made. And his point was that there is no way that you can get a basis adjustment under 1014 if the assets are not includable in the gross estate. If that grantor trust is drafted in a way, as you always do with this kind of a plan, with an installment sale plan, if the trust is drafted in a way that it's out of the grantor's estate, there is absolutely no way that you can get a basis step up. And he was kind of inclined to recommend that the article not be published. And so we spoke about it at some length, he and I did. And his main point was this, and I think it's helpful to get this on the table. His main point was that he had actually been involved in the drafting, believe it or not, of 1014 in 1954. I believe, if I recall correctly, I'm going back 20 years now, that he had worked on the committee. He was a staff member of the committee, probably the joint committee. I don't remember which committee, but I think it was the joint committee. Anyway, and he said, we did not contemplate this. We expected that it would be estate tax inclusion that would lead to the basis step up. Putting aside, of course, something like community property, as Jonathan said, which is explicitly accepted, explicitly provided for, you don't need estate tax inclusion. So what we did was, what I said to him was that what you need to appreciate or think about is that, yes, this was drafted in 1954, but some 30 years later, the IRS comes in with Revenue Ruling 85-13. By the way, in 1980, 5 years before that, they adopt this principle in a regulation, in example 5 in the regs under 1001-2. I said, but if you take into account that authority, this what we call the deemed ownership principle, that the assets in the trust are, in a grantor trust, are deemed to be owned by the grantor for income tax purposes, not for estate tax purposes, for income tax purposes. If you want to talk about whether the trust is going to be includable in the grantor's gross estate for estate tax purposes, you got to look at sections that we're all familiar with, like 2036 of the code or 2038. But assuming the trust, is drafted in a way so that neither of those provisions can apply, not included in the estate for estate tax purposes, but for income tax purposes, 8513 establishes a special deemed ownership rule. And in 1954, when they drafted 1014, it wasn't even on the horizon. No one could have anticipated that we would get 30 years later a deemed ownership principle from the IRS. And what I was saying to him was, if there is a deemed ownership principle embedded in the code, and the service wants to go with that principle, then they got to fully ride that principle. It's either, they can't turn it on or off as it suits them. If we have a deemed ownership principle, then that should be the law across the board. Now, in example 5, we have a deemed ownership principle where there's a grantor trust and the grantor turns off his or her power, his grantor trust power, turns off grantor trust status. And the IRS and the regulation, example 5, says that triggers gain. It was the asset was subject to a liability in excess of basis, and the turning off of that grantor trust power triggered gain. It was a partnership interest in example 5 that the grantor owned. And what the example does is it treats the grantor as if he or she had made an inter vivos gift of the partnership interest. So you see the point, right? The deemed ownership principle. Obviously, the grantor did not own the partnership interest. It was, as a matter of state law, it's very clear the partnership interest was owned by the trust. But the grantor had this grantor trust power, which made it a grantor trust, and the regulation says when he turned off or she turned off that power, that was the equivalent of a sale. That triggered gain. And because the taxpayer, the grantor, was deemed to have owned that partnership interest. Turn off the power, it's equivalent to the grantor having made a gift of the partnership interest. That's the example. Now, by the way, I get it. I get why the IRS did that. There was a lot of this in the air back at in that time frame. Jonathan and I were just discussing this before we began today, actually. In that time frame, there was a lot of concern about people taking tax shelters and trying to avoid having to recognize what we might call as recapture gain, right? They took the deductions, they reduced their basis, there was still liability hanging over the asset. They then wanted to get rid of the asset without having to trigger recapture gain. And the IRS was concerned about that. And so an example 5, which came in 1980, as we say, is designed to address exactly that. So they come up with a deemed ownership principle to deal with it. And as I said a moment ago, it seems to me if you want to have a principle like that, if you want to interpret section 671, which is what they're interpreting, to say the grantor of a grantor trust is deemed to own the assets in the trust, then you've got to ride that principle throughout on a uniform basis. You can't say, oh, the IRS, I don't think should be able to say, we're going to say there's gain in example 5 to the taxpayer, but for other purposes where it may not cut for us, where it may cut against the IRS's position, we're going to say we want to ignore or deny the existence of the deemed ownership principle. So I think there's a kind of, and we point this out in our new article, that there's a kind of uniformity requirement that they need to interpret 671 in a uniform way. Either we have a deemed ownership principle or we don't, but it can't be, oh, today, example 5, we have a deemed ownership principle because it produces gain for the taxpayer. When we get to 1014, that's the taxpayer would like to apply the deemed ownership principle. We don't want to permit that because that will hurt the fisc. Our point, one of the points we make in the article is the IRS cannot take that kind of an inconsistent position. Now, of course, Congress could do it. If Congress wanted to say, hey, let's amend section 671 and say it's a grantor trust in the context of example 5, where someone's trying to turn off the grantor trust power to escape the recapture gain, but at death you can't get 1014 because the deemed ownership principle should not apply in that context. Of course, Congress is free to do it. But the question is, can the IRS do it based on a section 671, which in no way admits of this kind of two-track system, where the IRS can use the deemed ownership principle when it works for the IRS and reject it when it hurts the IRS. So anyway, that was our basic point. I gave you a long-winded version of that conversation, but the bottom line was that in 1985, the world changed when the IRS issued 8513, and maybe even, as I say earlier, in the 80 reg, and maybe even before that, For example, there was Rev 77-402 and so forth. There was some other authority. But in any event, my point was that after 1014 had been adopted, the world shifted. At the end of the call, he said to me, and this was a long call, he said, I see your point. He hadn't seen it. He was very much locked into the idea that 1014 required estate tax inclusion, and he hadn't taken into account, he hadn't integrated into his thinking about it, the fact that the IRS in later years came up with this deemed ownership principle and that it needed to be respected. And so he backed off and he said, go with the article. Absolutely, he wanted to publish it. I wanted to say one more thing about this. Go ahead, Jonathan.
Well, Mitchell, I remember you're calling me about this. This was very exciting and, as you said, controversial with a lot of people. But I think he said to you at the end, this will be the most exciting article we've published in a decade.
I think so. I think so.
And it really is. It really is an exciting thing. But as Mitchell said, it goes on the IRS's own development of the deemed ownership principle. Again, we're going to bring up a little copy of Section 671 later. 671 does not say the grantor owns the asset. It just has a rule about imputing income deductions and credits to the grantor, but it doesn't say the grantor owns it. But the service, because it's interested in the fisc, again, you can quote me, the IRS is only in it for the money. You can go ahead and again, you can put that on my gravestone. The IRS is only in it for the money, but it came out with the deemed ownership principle to stick taxpayers, but Mitchell and I may have turned it around to actually help taxpayers in some cases.
Go ahead, Marty.
I want to ask you, Mitchell, because it was fascinating. I never heard the whole backstory, but I'd like you to just reiterate something you said, because I think it's just really important and interesting. And I think people have perhaps misexplained some of what you and Jonathan did in the article. If I heard you correctly, what you were saying was you acknowledge the potential issues with the position of taking a basis step up when it's not in the estate. But what you were doing is trying to argue for logical consistency in the IRS positions that they've taken. So it wasn't that you were saying this is necessarily correct. You were really saying to be consistent within the IRS positions. Maybe you could just.
Yeah. Let me
I think that's very important.
Thanks, Marty. Let me elaborate just a little bit more on that. I'll tell you two quick things that might be of interest. So one thing I have found over the years when I teach 8513, and I get to the question of what's the basis of the assets in the grantor trust, after I get the students to really internalize the idea that the grantor is deemed to own the assets in the trust, their reflexive reaction is, why doesn't 1014 apply? I mean, so their intuitive reaction is different, of course, than ours, right? As you know, as people who are immersed in this for many years, we kind of have this other idea that, gee, it's got to be includable, as did the editor of the Journal of Taxation. You can't get a 1014 step up without getting through estate tax inclusion. But without having that kind of principle internalized, their intuitive reaction is, well, if the grantor is deemed to own it for income tax purposes, why doesn't that suffice? Consistent with what you're saying, Marty, I would add one more thing. I try to be, as an academic, I try to call it fairly. I don't want to be pro-taxpayer. I don't want to be pro-IRS. I want to just try to be right down the middle and call it as I see it, to the extent that I can. And so I taught a couple of courses to IRS personnel some years ago. And when I talked about 8513, I told them, and people from the national office were in the audience. Indeed, they were right in the classroom. Other students from around the country were getting it by satellite, but they were sitting there in the front row looking at me. And I said, probably the worst thing you guys ever did in terms of estate planning is 8513. And I suggested to them, you probably need to think about redoing it or going back to it or getting rid of it. But I think 8513 was a big giveaway for the reasons that Jonathan has discussed. I mean, we can get into it further, but I do think 8513 was a giveaway. And one of the inadvertent, I think, things that comes from 8513 is this idea that if you're deemed to own it for income tax purposes, you should get a 1014 step up. Now, it's interesting, I think, that our idea, which we put out there in 2002, and we've seen some action a little bit here and there, as Jonathan says, the 2009 CCA, the 2012 PLR, you know, some reaction to it. People have talked about it, certainly, but some 20 years later, I feel kind of vindicated in making this argument, because here we have the IRS in Rev Rule 2023-2 saying, hey, we got to deal with this issue. We have to say that you don't get a 1014 basis adjustment simply because the asset's in a grantor trust if it's not includable in the gross estate. They felt the need to come back to that, given, I think, what we put out there, and said, hey, the logic, as you say, Marty, we're looking for consistency in the logic, and we explored, you know, how to not give a 1014 basis step up would create inconsistency in the logic. Now, of course, the problem is that the IRS, I think, did a rather poor job in 2023-2. It's shocking to me, and I don't want to put words in your mouth, Jonathan. I think you agree. I remember we've talked about this so many times. I can't remember what we said. We've been back and forth on this as we've written our new article so many times. I don't even know where my ideas begin and yours end, or yours begin and mine end. I don't know who's responsible for what here. But it's quite shocking, I think, that in Revenue Ruling 2023-2, they do not, hold on to your seatbelts, they do not cite 8513. How could you do that? They don't cite example 5. I mean, that was your point, Jonathan, right off the bat. Where's example 5 in this ruling?
Right. Remember, the regulation is the law. The IRS can sometimes argue against, it can disavow a revenue ruling, but a regulation is the law. And that's where the deemed ownership principle is. Read example 5 of Reg 1.1001-2C, and it is so explicit. And it says the grantor owns the assets in the grantor trust. And in fact, the grantor is the partner in the partnership, which is owned by the grantor trust. It's very clear. It's very explicit. It's even broader than Revenue Ruling 85-13. That's the nub. And for the IRS to have that out there, you know, for almost 30 years and now come back and say, well, we don't like the result of that. But Mitchell, tell us what 2023-2 basically says.
Yeah, I was just going to add, Jonathan, to what you were saying. I totally agree with you. The U.S. Supreme Court says that regulations have, quote, force of law effect. Force of law effect. So that's example 5. Much more important than a mere revenue ruling, comparatively. But there we go. They've embedded it in the law. And now they want to walk away from it in 2023-2, and shockingly, without even citing it. And you know, it's hard to understand why they didn't grapple with the deemed ownership principle. I mean, you know, hard to understand how they did not do that. Now, essentially, what 2023-2 says is very modest, and modest, and I think you agree with me, Jonathan. Not very with it, if you will. Okay, so what it says is that 1014 does not apply to assets in a grantor trust, unless of course the trust is drafted in such a way so that estate tax inclusion is the proper result. So again, assuming no estate tax inclusion, the ruling concludes that 1014 does not apply. Now, a couple of things. So I think we should talk about the rationale. Why doesn't 1014 apply? The other thing I think is worth mentioning is the carve-outs. The carve-outs are important. So the carve-outs are, number one, this ruling does not apply with respect to negative basis assets. You know, an asset where the liability on the asset, encumbering the asset, exceeds its basis, okay, which is going to be very common in these installment sale cases. A second carve-out is if there's any liability between the grantor and the grantor trust. If the trust owes money to the grantor, which is going to be typical in these installment sale cases, or vice versa, the grantor owes money to the trust, again, the ruling doesn't apply. So
by its terms, it says this does not apply in those cases.
Right, and so as we say, I'm telling you as if you don't know this, Jonathan, but as we say in our new article, right, they missed their target.
Exactly.
If they were going after these installment sale techniques, right, which is where you're going to have some debt back and forth, maybe some negative basis property, but certainly some debt back and forth between the trust and the grantor, the ruling doesn't, as you say, by its own terms, doesn't apply. So what the heck did they do? So they came back 20 years later to respond to our assertion, and they try to refute us without reasoning, right? They simply adopt the conclusion that 1014 doesn't apply based on state law. We'll talk about that in a moment, okay? And then they miss their target, and they don't deal with the real issue, which is the deemed ownership principle. How did the deemed ownership principle disappear from the law? As Jonathan says, if it's in example 5, it's force of law. It's in the revenue ruling. They haven't obsoleted or revoked that revenue ruling. They haven't done anything to the regulation. They just assert that from now on you can't get 1014 without dealing with the deemed ownership principle. So now what's their rationale? Their big rationale is this. They look at state law and they say, let's look at the state law definition of a bequest, because 1014B1 says that if the recipient acquires the property by bequest, there's a step up. And B1, this is very important, B1, unlike B9, does not require estate tax inclusion. So if you get property by a bequest, 1014B1 gives you a step up, even though the property was not included in the gross estate, unlike B9. And they say, so how do they deal with that? How do we deal with B1? Was there a bequest here? And they say, let's go look at state law. And under state law, I think we'd all agree, a state law definition of a bequest does not encompass this kind of an arrangement. You know, you have an inter vivos trust. When at some point the income interest terminates, the remainder person gets the property. That's not something we would ordinarily construe as a bequest. It's not something from someone's will. It's not a testamentary trust. We don't ordinarily think of inter vivos trust as creating a bequest as a matter of state law, with which I don't think we disagree. I don't think anybody would disagree with that. But taking state law and making it preemptive and failing to consider the deemed ownership principle, which overrides state law, is, I think, a huge mistake. I mean, again, go back to example 5. In example 5, the grantor trust owns the partnership interest. The regulation applies the deemed ownership principle and views the grantor as having gifted or transferred the partnership interest, even though as a matter of state law, he did not or she did not own a partnership interest. And so their failure to appreciate that you need to respect the deemed ownership principle, it's a tax rule that overrides state law, is really very troubling. So that's where I think they go wrong. I think as a practical matter, as a result of all of this, I think as a practical matter, if this ever gets to court, I would imagine that a court would be very resistant to giving any deference to the IRS's views in this ruling for a couple of reasons. One, the IRS has been inconsistent, right? They've taken a contrary position, as Jonathan pointed out, in the PLR. And that inconsistency in a PLR cuts against deference for a revenue ruling. So if the IRS shows up in court and says, oh, you know, we're the experts, give us deference for our position in this revenue ruling, we know how to administer the tax law, we're entitled to deference. We call that, we talk about this in a chapter in our book, Jonathan and I, it's called Skidmore deference. You can take a look at our book if you're interested. We're not going to get into it here, of course, but it's a light form of deference, less deference than the IRS gets for a regulation, which is called Chevron deference. But although Chevron is up for grabs right now, the Supreme Court just granted cert to review the whole concept next year. But in any event, I think the IRS's inconsistency would very much cut against them getting any deference for this revenue ruling. The second problem, which I think is another fatal problem in terms of deference, is they don't grapple with the deemed ownership rule. I mean, if they had said, you know, Mitchell, what do you think we should do with this in drafting the ruling? I would have said, you've got to cite 8513. You've got to acknowledge example 5, and you've got to reason your way through why the deemed ownership principle doesn't apply in this context. If you fail to do that, if you fail to grapple with the issues, taxpayer is going to say, that's just a conclusory assertion and should get no deference. And I think that's where courts would come out. So I don't know how much they accomplished. Perhaps they were thinking, okay, we'll put taxpayers in a position where they're going to have to disclose this on the returns, because otherwise they may be concerned about a vulnerability to a penalty. And maybe that's what they were thinking. You know, you're taking a position that's contrary to a revenue ruling and you're not disclosing it. Maybe you've got a penalty problem. But, you know, I'm not even sure that works, because as we say in our new article, the taxpayer would have substantial authority in the form of example 5, right? I mean,
and indeed, Mitchell, if this has arisen from an installment sale to a grantor trust, the revenue ruling doesn't apply. So you wouldn't have to worry about the IRS saying, oh, you should have, you know, you got to pay a penalty. I mean,
I agree. I agree. I lost my own point. Thanks, Jonathan, for bringing me back. You're absolutely right. So you're absolutely right. So at the end of the day, even assuming they came in and they asserted 2023-2 says you can't get a basis adjustment. I went through all of this about penalties and deference. You don't even have to get there. Your first line of defense, Jonathan, is the ruling doesn't apply by its own terms. So don't talk to me about deference and don't talk to me about penalties. So it's I don't know what happened here. Somewhere
Do you think it was just pressure? It was just pressure from the various senators that wrote Janet Yellen saying you got to do something?
Marty, that could well be, because Representative Pasquale of New Jersey is a very bright guy, and he wrote a very strong letter to Janet Yellen saying you've got to do this. And of course, Bernie Sanders had this bill saying you can't get a stepped up basis if the assets are in a grantor trust, but not includable in the grantor's gross estate. So there was a lot of pressure on them. Now, as everybody knows, there were a lot of proposals made before the last election, and there was a chance that the government was going to adopt rules which would have vitiated this issue, because they would have taken away the stepped up basis and it would all be academic, at least on a prospective basis. But, you know, who knows if, when at all, they will ever come up with a rule eliminating Section 1014. Marty, go to our next slide.
I want to ask a question before I go on. I'm controlling the slides so I can ask questions. So, Mitchell, you made some very interesting comments. One of the ones that just kind of resonates, you know, you're not pro taxpayer, pro IRS. You're really viewing this as an objective academic, just analyzing it intellectually. And I hear your arguments and I hear the position you're advocating. It seems to me that the political pressure, as we just spoke, was really the motivation behind this. And maybe not a lot of thought or time went into it as they might have wanted to. They just needed to react, because we may never know what really happened behind the scenes of that letter. But why do so many practitioners take such a incredibly strong view that what you're saying is so wrong, given that you're coming at it from an intellectually honest perspective, and you have reasoning about the inconsistencies with the service? Why is there such a harsh view of this opinion?
Well, you know, if I go back and
this discussion, it's not even an opinion necessarily, it's a discussion.
Well, thank you for the question, Marty. I think it's a good question. And if I go back and I put my academic hat back on, which is what you're essentially asking me to do, you know, from a policy point of view, this strategy is, from a taxpayer's perspective, nirvana. I mean, look at what it can accomplish, right? So I can put my property into a trust that's going to be out of my estate. And if I'm selling it to the trust, I'm not going to have to pay any gift tax. If I sell it for the right price, I'm not going to be making a taxable gift, right? I'm not going to be taking gift tax risk where the IRS comes in and audits. I mean, I have the risk I could have been off by a little bit, but I don't have much beyond that. I don't have a gift tax. I'm not making a taxable gift. I'm making a sale, so it's not a gift. It's not a gift, but I don't have to pay gains tax, a capital gains tax on the sale because of 8513, right? I'm getting all of the appreciation that this property will produce post-transaction out of my estate, again, without making a taxable gift, and again, without paying a capital gains tax. And now taxpayers, pigs that they are, want to claim, in addition, a basis adjustment under 1014, treating them as if they never made the gift in the first place. So on the one hand, they say, you know, it's out of my estate. I want to keep out all the appreciation. I haven't made a gift, I haven't made a sale, and now I want to be treated as if I continue to own the asset and give me an income tax basis adjustment. It's problematic as a policy matter. And so
I'm sorry to interrupt. I just have to say, this is like better than having your cake and eating it too.
Yes, it is. I totally agree. It's nirvana. It's really nirvana. And,
nirvana.
And then you add in what Jonathan said before about 2004-64, when the grantor pays the income tax on the trust income, the grantor doesn't make an additional taxable gift and gets all that compounding. I mean, it's shockingly, amazingly wonderful from a taxpayer's perspective. And so it's very easy to appreciate the pressure, the practical pressure, the political pressure, the policy pressure to do something about this. And indeed, as I said before, remember, I was lecturing the IRS and saying, you guys gave the kitchen sink away when you issued 8513. Look at what's going on out there based on 8513. And that was several years ago. I talked to them about that. So I think, from a policy point of view, it makes sense to do something about this. The point I'm making here, and that Jonathan is making, we're making in this article, is they did a very poor job of doing what they did, right? Why, I don't know why they didn't get into the question of the deemed ownership principle. I think they should have also gotten into the question of, is there gain at death? I think they also should have gotten into the question of, well, what is the basis? That's an interesting question. If the ruling says that you can't get 1014 basis determined under 1014, how then do you determine the basis? Is it under 1012 or is it under 1015? We don't know the answer to that. It's very critical, right? Because let's take an example. Let's say that the purchase price of the asset is $10 million and that the grantor's base, the trust gives the grantor a note for 10 million and the grantor's basis is only $1 million. We're not going to have recognition of gain. 8513 says deemed ownership, you still own the asset, you don't have any gain. What's the trust basis in the asset? Is it the grantor's basis of $1 million? Or is it the $10 million that the trust agreed to pay for? Or is it the $20 million value of the asset at the time of death under 1014? So once you take 1014 off the table, it's not 20 million, assuming the IRS is right, assuming they're right, it's not the $20 million value at the time of death. Is it the $10 million amount that the trust agreed to pay for the asset? Or is it the grantor's basis of 1 million? The ruling doesn't tell us. We don't know the answer to that. We had a call. I don't remember, Marty, if you were on the call. Jonathan and I were on a call a few weeks ago where we discussed this issue, and Jonathan and I gave our views. And I kind of indicated almost on the fly. I hadn't spent a lot of time thinking about it ahead of time, but I kind of indicated, and I didn't get any pushback with this. I kind of indicated that if 1014 doesn't apply, and that's a big if, that's what the ruling seeks to say, however inartfully. But if 1014 doesn't apply, we're left with either 1012 or 1015. And I said, I think 1015B is probably where I would come out, assuming 1014 doesn't apply. And my reasoning for that was, if you take a look at the language of 1012B, and it's getting late, I don't think we're going to go here into any further detail. But if you take a look at the language of 1012B, it looks like it's more specifically tailored to this kind of a transaction involving a purchase than 1012. Involving a purchase, I should say, with a trust. Where the trust is making a purchase from the grantor, I think 1015B looks a little bit more specifically tailored to the situation than the more general provision in 1012, which simply says, if you make a purchase, your basis is your cost. So, and in fact, I'm reminded, just this morning, I'm reading a new 7th Circuit case that just came down, where the court was saying, we've got a general provision in the code, we've got a specific provision in the code, we're going to tip our hat to the specific provision over the general provision. A very straightforward canon of statutory construction. So I think, could be that maybe 1015B would be the determinative section rather than 1012. Now remember, if it's 1012, the trust basis is going to be $10 million. That's what they agreed to pay for the asset, even though the gain of 9 million was never recognized by the grantor. Again, you get into counterintuitive territory, right? The trust gets a basis of 10 million. The grantor had a basis of 1 million, never paid a tax on the gain. Now, of course, we were saying maybe the basis is 20 million because 1014 applies. But anyway, those are the stakes here. That's why I said at the outset, I think it's a kind of a process of elimination. Is it 1014? Is it 1015A? Is it 1015B? Is it 1012? Those are the only choices we have. I mean, you can't make up another provision, right? You can't say, you can't pull it out from, from behind my ear and say, oh, I think the basis should be this because that's what seems fair to me. That's not the way the law works, right? We got to have a theory. We got to have a section. It's one of those sections.
Do you think that's what really is motivating some of the people that are strongly against what you're saying, is just from the fairness or conceptual framework, like you said before, where it's like tax nirvana, because you're not reporting it, because this, because that. It just, if you're not including in the state, why should you get a basis? Is it just, do you think they're just reacting from sort of a visceral fairness perspective to you rather than following the logic?
I don't even think it's visceral. I think there is a strong policy, or as you say, fairness dynamic here. I mean, you tell me, do you think that it makes sense that you should be able to get what I would call fixation of value? It's a term I use for my students. What I mean by that is post-transaction appreciation is out of your estate. You're locking that appreciation out, right? Typically, in order to get that, you have to make a taxable gift. The code makes that very clear, right? You make a taxable gift, any post-gift appreciation is out of your estate. Now, you can do this. You can get that post-gift, post-transaction appreciation out of your estate without making a gift. You just make a sale. Oh, but what about the capital gains tax? Well, 8513 defeats the capital gains tax. And then, right, we want a basis adjustment under 1014, and then we're going to throw in 2004 there, 64, and let the grantor pay the trust income tax, gift tax free. I mean, I think it's problematic from a policy perspective. I do. And by the way, people who don't engage in this kind of planning don't get any of these benefits, right? I mean, and think about this. Jonathan and I came to the conclusion years ago. I don't think he said it today, but I remember we were discussing this and we came to the conclusion a long time ago. And I think Jonathan has implemented this practice, uniformly throughout. Always have your client make gifts through grantor trusts. You should never make a gift outright. Always make a gift through a grantor trust.
Absolutely. You never want to do that.
And I want to add in one more. I'm going to add in one more thing that we didn't get to, and I think is very important. I know you have it on the slide, but we didn't get to it. So think about this. You make the gift through the grantor trust, and now the grantor can pay the income tax on the asset, gift tax free, which you could not do if you made it an outright gift, right?
Correct.
That's dynamite right off the bat, right? And now watch this in terms of basis. And this is an important thing, important piece that Revenue Ruling 2023-2 does not touch. I want to repeat, if you take away one thought from this little discussion, this is a key thought. 2023-2 does not in any way impact this piece of planning. The client is dying, okay? The assets in the grantor trust, the asset has a basis of say $1 and it's worth 10 million. The client buys it back for 10 million. There's no gain because 8513 remains totally intact. Now that $10 million asset's included in the grantor's estate, boom, you get a basis step up. So anybody who knows how to play this game, I used to say, I've told my students this, I've said, if you have a list of deathbed planning, put on your list the question, do you have any grantor trusts? And if you do, let's take a look at the assets and see if we can buy them back.
In fact, this purchase just before death, and it doesn't have to be the day before, it could be a year before, it could be years before. Once you have a lot of appreciation and you don't want to pay tax on that gain, you go out and you borrow the money from a bank. There's an issue if you buy it for a note, that may mean that basis in the note is zero. We don't know that, but you borrow the money from a bank, and what you do is you don't buy all the assets back. You only buy those assets which have increased in value. And if you're a typical investor, you will have assets, some which have gone up, some which have gone down. But you don't want to buy those assets back and have them includable in your estate if their value has gone down. So that's even a better deal. And 2023-2 doesn't touch that. It's left open. And in fact, I've done that dozens of times with my clients. Now, what you've got to do when you do an installment sale or make a transfer to a grantor trust, you've got to check with your clients regularly as to what is the health of your client. And one of the things you want to do is to set up, if you have to borrow the money, you want to set that up well ahead of time. because the first time I did this, which was in the early 2000s, I'd even gone to the Chase Manhattan Bank. It was a huge transaction, very low basis. It was about $2 million that I had to borrow, and we had everything secured. But the Chase, which Milbank was their counsel, was too afraid to do it. So I went to 3 or 4 other banks, and finally, on a Friday afternoon, the trust officer called me back and said, Jonathan, we will make that loan to the, and here's how it happened. You loan it to the client. The client buys it back on Friday afternoon. The client dies on Saturday. And on Monday, you sell it back to the trust, which has the cash, and you pay it back to the bank. But don't wait. Set up your line of credit with a bank well ahead of time, because if you go in just before death and you try to convince a trust officer or a bank lender to make this huge loan, you're going to have real trouble with them. So what I began to do is we would have a regular luncheon once a year with the banker, so we knew we had that money. And by the way, the money's never going to leave the bank. It's going to be loaned to the donor, the grantor, maybe through a power of attorney. He or she is then going to buy the assets from the trust by transferring the assets to the trust. For a fee, the trust can even guarantee the debt of the grantor. And then when the grantor dies, the assets are going to be includable in her estate. You'll get the stepped up basis. And don't do it the same day, but the next day, you can sell the assets back from the client to the grantor trust. And maybe there'll be a little bit of tax friction there because you're no longer going to be dealing with the grantor trust, because by definition, the grantor is dead. But that's something that this revenue ruling doesn't touch. So, you know, when people call me and say, can I do this? Don't wait until death. Plan for it well ahead of time. And none of the positions the service has taken would have any impact on that. And that, as I said, is even better than getting the step up, because there also could be a step down. This way, you can pick and choose and buy only those assets which have appreciated in value.
So to come back, I was simply going to say, so the takeaway here, I think, as we said a moment ago, is never make gifts outside of a grantor trust context. Anytime a client wants to make a gift, they should be told, do it in the grantor trust. If it's feasible for other reasons, for non-tax reasons, that's the way it should be done. And it seems to me the takeaway on this is, I'm thinking to myself, I'm coining a new term in my own mind here, right? Repurchase in contemplation of death.
But there is no 3-year rule, there's no 1-year rule, there's no 1-hour rule.
Exactly. It sounds pejorative, you know, any kind of deathbed planning always sounds pejorative, and the IRS is not going to like it, and you're going to wind up in the battle. Not here. 8513 blesses you. No problem. Repurchase in contemplation of death.
Great phrase, Mitchell.
So for those that feel your proposed interpretation of 1014 and Revenue Ruling 2023-2 is just too far out, you're accomplishing the same thing with the substitution or swap transaction.
Yes.
That nobody really questions.
Yes.
No.
Yes.
So why is it? So why?
Yeah, we make the point in the article that as we shift over to policy and we say this ruling creates an inequity. This ruling results in an inequitable system, right? Because people who do the repurchase and contemplation of death get the basis step up, and people who just don't get around to doing it, or who die of a sudden heart attack and fail to get an opportunity to do this, they don't get this basis step up. Now, you know, how do you justify that inequity? You can't.
Well,
And so as long as you leave 8513 on the books, which leaves on the books the repurchase and contemplation of death strategy, you are punishing the people who didn't get that counsel or who didn't get a chance to use it. And I think that inequity is very problematic, which again goes back to the point we make in the article, and that is they got to grapple with 8513, and they don't. They don't even cite it, as we say.
So for those, again, that feel your interpretations of Revenue Ruling 2023-2 is too taxpayer friendly, even though you said you're taking this from an academic perspective and you gave the logic, fine. Don't argue about 2023-2, plan a swap. You can get the same result.
Absolutely.
I want to add a point to Jonathan's comments about the swap. Makes a world of sense to set it up. not only should you get the line of credit set up, and I'm actually talking with a client and their general counsel's talking to a lender now for this very, very reason. But I've suggested we should get all the documents drafted now. So literally the only thing to do is pop in the date and put a signature on it, because I don't want to have somebody spend a week or two to figure out what kind of documents to draft. There's a bunch of different real estate assets. Let's get them all done now. But the real fly in that ointment is that clients don't come back for regular annual reviews. Everybody on the advisor team, the wealth advisor, the trust officer, the attorney, the accountant, has to hammer and educate and kind of hammer the clients. You got to talk to the team once a year periodically. And if something is happening like a health development, you got to jump on it. Too often clients wait to pass the last minute, and it becomes impossible to do this. And I think just from Mitchell's excitement, if we could put that in a bottle, this is like, this is tax nirvana. Don't lose out on it. But we got to get the clients to have those meetings so we can plan this. If a client hasn't been back in a decade, maybe just based on age, we should be setting up the lines of credit and drafting documents. But if the client won't come and talk to the estate planner, and this is off the radar, or the wealth advisor and the accountant is focused on compliance, this opportunity that got Mitchell is more excited than I've ever seen him in all the years I know him. You're going to lose this. You don't want to lose this.
Hey, Marty, would you bring up the questions which have been sent to ILS? And Vanessa, are you still there?
I am here, Jonathan.
Well, I'd
Let me see
like
if I can
you
get my
to
camera on.
tell us about these questions.
Well,
that
wait. First, you have to say, Vanessa, you're an amazing human being. You're still awake.
No,
Come on.
I mean, how could you not be with Mitchell's excitement? I agree. Mitchell was my professor. I've never seen him this excited. So it's been a really entertaining discussion. Well, so I had asked the presenters to put this slide in here just because our content team at ILS had received some questions that indicate there may be a misconception about this revenue ruling. And maybe it's not a broad misconception, but in my experience, if there are a couple of people who think it, there may be others. So I thought it best to clear this up. So the questions that have come in have been in the context of trusts that are drafted so that the assets in the trust are intentionally included in the grantor's estate, right? So we've been talking about, and the revenue ruling deals with a trust that is intended to be excluded from the grantor's estate. These questions had to do with trusts that were drafted so that the grantor held a power that caused estate inclusion. And they were both essentially for asset protection purposes. One was a domestic asset protection trust. The other was in the context of Medicaid planning. They were not drafted primarily for tax planning purposes, but for asset protection. So they wanted the inclusion in order to get the step up in basis. And they also happen to be grantor trusts. So the attorneys asking the question said, I'm concerned about this new revenue ruling 2023-2 and its effect on these trusts that I'm drafting because they're grantor trusts. I want the estate I want the step up in basis, but I'm worried now that because they're grantor trusts, I can't get the step up. And that's, I think, a misconception because in that situation, you're not relying on grantor trust status, you're not relying on this deemed ownership rule because it's a grantor trust for the step up in basis. 1014 clearly says that if the assets are included in the gross estate, that you get the step up. If they're passing at death and they're included in the gross estate. And so if you have a trust that is intentionally drafted to be included in the grantor's estate, taxable estate, I don't think you have to worry about getting the step up. I think you're going to get the step up under 1014, even if it's a grantor trust. So in other words, I don't think this ruling means that no grantor trust can receive the step up, the assets in a grantor trust can't receive the step up in basis under any circumstances. It's just that you can't get the step up just because it's a grantor trust. But if you have inclusion, I think you're still going to get the step up. So I don't know if any of you have additional comments or anything you want to add, but I just wanted to clear that up in case that misconception is out there.
I think one of the reasons for the misconceptions is and I want to thank Jonathan and no offense, Jonathan, even more so Mitchell. I thought that the discussions were very intellectual and balanced. Many people get very, very emotional over this topic, as they do about a lot of tax topics. That's, what could be more exciting. But I mean, there are those that feel that what Mitchell and Jonathan wrote about in their article way back yonder, I think it was 2002, and what they've had the audacity to say in public since then is something that's almost sacrilegious, that you should get this step up in basis even though the asset's not in your estate. And I think Mitchell in particular, with the rationale behind it, gave a much more balanced view. But I think that the negativity in terms of how this position has been described by some, and some of the descriptions that I've heard where people have been very emotionally negative about it, have not gotten into the reasoning behind it. They've just been more emotional. But on the other hand, I've seen people take a position that it's malpractice not to tell people to take this position or something to that effect. There's people like the extremes because it's more exciting and dynamic. But I at least in my humble view, I thought what you did was very intellectually honest and more middle of the road than things that I've heard from lots of other sources. I think those polarized extreme views is why some people have been concerned, oh my, is every grantor trust now going to be a problem? No, not at all.
Well, by the
Yeah,
way,
I think that's right.
you're,
Sorry, I was just going to say, I do agree with that because I think that it's so, to some people, it's the concept that it would be, you would get the step up because it's a grantor trust is so sort of out there that they think this ruling must be saying something other than what it's saying. But
Much worse,
right, exactly. So I just wanted to clear that up, that it's not.
and Vanessa, based on this issue, Bernie Crooks, who's a very famous elder law attorney, and I wrote an article, I don't know, 10 or 12 years ago, about even if you're doing a Medicaid trust, you still want to make sure it's in the estate. It's going to be a grantor trust, and we said just give the grantor these powers and you'll get the estate tax inclusion. And you don't care about the estate tax inclusion because these are generally people who don't have an awful lot of wealth, and there'll be no estate tax paid. I mean, the worst thing you can do is to make a transfer of assets that are appreciated at death and not have them includable in the estate, even though you'd owe no estate tax. So, it's out there, but there's just no question that you will, if you have one of the string provision, 2036, because of a, entitlement to income, or 2036A2, power to control the beneficial enjoyment of it, even though you can't get it back yourself, or 2038, or certain other sections, it's going to be in the gross estate, and you're definitely going to get the stepped up basis.
Just also keep in mind, we didn't discuss, and I think we're getting near the end of time, powers of appointment, general powers. There's a range of other techniques that can be used to get that same basis step up that's being sought.
Absolutely. Yes. Well, I'm going to drop off again and give you back the spotlight. But thank you for letting me talk about this issue, because hopefully it cleared it up for some people who may have also had that misconception.
Mitchell, Jonathan, do you guys want to make sort of a summary, conclusion, wrap up comment, each of you?
Well, the only thing I'm going to say is that Mitchell and I tried to be intellectually honest about this. We have some question about whether the IRS is being intellectually honest. And, quote me again, the IRS is only in it for the money. It would love it if you can have the rules apply where it creates money for the IRS, but not have it apply where it takes money away from the IRS. I think that's always true. Of course, taxpayers try to do the opposite. When it makes money, they'll want it come out one way, and when there's tax to pay, they'll want it to come out another way. But I certainly think that I think the safest thing to do is to have your client contact you well before death, when there's a lot of appreciation, to arrange for the borrowing of money and buy it back, or the client may have highly appreciated assets which can be used. I think that's the big takeaway here. I also think that we've demonstrated that you certainly have a very legitimate ground to say that assets that are includable in a grantor trust at death get a change in basis automatically, and I think you can take that position. You may want to disclose it on your return, even though, as Mitchell said, the IRS has taken inconsistent positions, which means you may not have to. But if you want to be sure that there's not going to be any penalty, go ahead and do it. By the way, I've done this for clients dozens of times. Of course, you don't put it on the estate tax return. This only comes up when the asset is sold. And if you feel, I just have to tell the IRS what we did, go ahead and add something in there. Mitchell, anything more?
No, I just wanted to say thank you, both of you, all three of you. And thank you for the chance to do this. It was a lot of fun. The one thing I would leave the audience with is take a look at our article that was coming out. And I think, when is it, Jonathan? Is it?
It's September 2023 Journal of Taxation, exactly 21 years after our original article appeared.
Exactly. Take a look at our new article. I think it lays out everything we discussed here, and I'm hoping it would offer some insights that would be helpful.
Hey, Marty, what I want to do is if you would go back a couple of slides, I just want to.
I have to make a comment, Jonathan. I heard a rumor that you and Mitchell are going to be selling for only $10,000 autographed copies of the article on eBay. Is that true?
Well, you caught us, Marty. I want to go back and I want Mitchell to discuss two cases that are kind of important for people to look on.
Here you are.
Yeah, here it is. Mitchell mentioned these, the Backermeyer case and the Levine case.
Yeah, so this gets into the question of whether there can be or should be recognition of gain at death. Let's say, for example, I own an asset. Forget about grantor trust. I own an asset that's a negative basis asset, so that the liability encumbering the asset is greater than my basis in it. So some have raised the question, does that somehow trigger gain at my death? Now, if I made an inter vivos gift of that asset, if I have an asset, let's say it's with a $1 million basis and it's encumbered by a $10 million liability, and I make an inter vivos gift of that asset, that triggers gain. That triggers gain. Just like in example 5, if I have it in a grantor trust and I turn off the grantor trust status during my lifetime, that triggers the gain. But what about if I die with the asset? Does that, and so it's a negative basis asset, I die with it. A lot of real estate investors are in this position, right? They have an asset with a low basis and a high liability compared to the basis. Do they have gain recognition? And, we don't have really great law on this point. We've discussed this. We discussed this at some length in our earlier Journal of Taxation article, and we conclude there should not be gain recognition at death. But here's some authority that we have on the slide, a 2016 case from the tax court, which I think, although it doesn't deal with negative basis and gain at death, it says non-recognition on death is among the strongest principles inherent in the income tax. So I think we saw that language and thought this is really quite relevant and quite compelling. And then in addition, if you're interested in this issue, we just added this citation to this Second Circuit case called Levine. At the very end of the opinion in Levine, the Second Circuit says, well, it's one thing if you make an inter vivos gift of a negative basis asset, that triggers the gain under Crane. But Crane does not apply, does not trigger the gain in the case of a testamentary transfer. So these two cases get us very close to the proposition that there should be no gain recognition at death just because there's an asset subject to a liability in excess of basis. Now, this could be very relevant in terms of a grantor trust to the extent people have raised the question whether at my death, the trust owes me a debt. Maybe the debt's in excess of basis. Does that in some way trigger gain? I think these two cases are very helpful on that issue. And I think, by the way, the service itself was concerned about this issue, and I think they wanted to stay away from it. They did not even dip their toe in the water of this issue in 2023-2. I think they were very concerned. My sense is, just my intuition, is that they're very uncomfortable about saying there's gain at death. And in fact, I think example 5 reflects that. Example 5 is put in the regulations in 1980. Levine is decided, as you can see on the slide, in 1980. So at that very moment, in the air was the question of, well, if I make an inter vivos gift of a negative basis asset, does that trigger gain? And the answer is yes. Or Levine says yes. What about a testamentary transfer? Do we want to go that far? And Levine says no. And then they come along with the example 5 in the regulation, and they say, inter vivos transfer, yes. They don't talk about testamentary transfer. The implication to me is pretty clear, doesn't apply in the case of a testamentary transfer. Anyway, Jonathan wanted you to have that background.
Well, also keep in mind that for income tax purposes, there is no debt. There's no debt. I mean, that's what 8513 and example 5 and the 1001 regulation. There's no debt because it's between the grantor and the grantor trust. There's no debt. So even if you're very, very worried if your client has a negative basis asset and she dies with that negative basis asset, the money is owed to a third party. Even if you're concerned about that, although these two cases suggest that there is none, and Tom McGrath and I looked at that issue carefully when we wrote our book in 1977 under carryover basis under the Tax Reform Act of 1976. If it's a grantor trust, there is no indebtedness for federal tax purposes. Well, Mitchell, thank you very much for joining us. Marty, thank you so much for putting this on. I hope people enjoyed it. It certainly, Mitchell, was a lot of fun for you and me, right?
Yeah, absolutely. My pleasure. We just relived the last 20 years.
I hope everyone else enjoyed it half as much as Mitchell did. So thank you for joining us, and good luck.